Okay, we are here today with Rob Nino of Premier Mortgage Resources. And this is going to be what I hope is the first of many Robcasts on the topic of lending and real estate. Rob, how you doing?
I'm doing great, Nance. Thanks for having me today.
Oh, yeah, you bet. If this were 25 years ago, we would be having this meeting in Whiskey Creek and we'd be preparing for our next karaoke song together. But here we are, all grown up and both working in the real estate field. For those of you who don't know, Rob is actually my nephew and my oldest nephew. And the reason why I asked to work on this project with you, Rob, is not just that you're a lender of 20 years and have a lot of experience in the field, but also because you bring other things to the table. You yourself are a real estate investor. You've done, you purchase foreclosures on the courthouse steps. You're a flipper, or you've been a flipper over the years, and so you have this wealth of knowledge above and beyond just lending that I think will be really helpful for people who are whether they're buying their first home or they're an investor, a seasoned investor. Your company offers all types of different loans. So, there's a lot that you bring to the table. But today we're going to talk about first-time home buying.
Okay.
And I know you work with a lot of first-time home buyers, and I do as well. And they are so precious as clients. They have so much excitement and they are so eager to learn. But there's a lot that they don't know. And if we can provide, information through this Robcast in both long form content on YouTube and short little clips on Instagram and elsewhere, I think it will be helpful for them. So
Great.
if you don't mind, I'm just going to get started with our questions and we'll just roll from there.
Yeah, great. I'll answer them the best I can.
Okay, sounds good. So, Rob, I'm a first-time home buyer. I want to buy a home. I've seen a lot of homes that I'd like to buy, but I don't know if I can afford them. How do I start the process?
There's two ways to do that, Nance. One, to start the process is first we want to have a conversation of what's our affordability. And there's two ways to do this. We can get you approved, but that doesn't mean that's what you can afford. We all have different monthly bills. We all have different levels of comfortability on payment wise. And so that's kind of the first thing we like to talk about is at least what are you looking at in terms of a payment, where people would say, I have no idea. Well, that's the best place to start. So once we kind of have that conversation, what we like to do is, well, you can go online and you fill out your loan application. We send you a link. Any lender in the world has them. They send you a link. It takes you about 10, 15 minutes and it gets automatically downloaded to us. Then we're able to look at all the documentation and kind of give you a better assessment of what the next plan would be.
Okay. So I'm gonna go off script a little bit and follow up on that with a question. So are you saying, and I think you are, that I may be approved for X amount of money, but I may and a month based on the payment, but I may not feel comfortable with that
Totally.
amount that I'm approved for?
Yeah.
Okay.
Very, very common.
Okay. Okay. So ultimately through this process, we also need to discover if I'm considering my comfort level, what I'm approved for doesn't really even matter. It really matters what I'm comfortable paying every single month as a monthly payment.
Yes. And what we do with people, especially exclusively with first-time home buyers, is tell them, hey, go home and actually make a budget. If right now you're paying X amount in rent, can you afford X times 2? Or are you saving X amount each month? So would that money be able to go to your mortgage? That's kind of a side thing on, just giving, the first-time home buyer some homework per se.
Yeah.
So that's like you said, it's a little off script from the lending side, but we really try and do that to help people help finance or manage their own finances. And because that's what a big step is when you're going to be buying a house.
Absolutely. And you saying that, puts into context a lot of times when you're renting, maybe you had a really good deal. Maybe you've been in the same place forever.
Right.
You might be renting for, $1,500 a month. And then your payment's going to end up being, if you're doing an FHA low money down loan, maybe your payment's going to be $4,000 a month. That's a significant leap. And you have to figure out where that money's coming from.
Right.
So,
100%.
Okay, great. What documents will I need to get pre-approved?
Documents you need would be, our main thing is income documentation, and it's generally 2 years. We go back 2 years of income. Now, we also get a lot of people who call and say, well, I haven't been at my job for 2 years, and they think that is a red flag stop. It's not at all. For example, if you graduate from college or a trade school, or you get a certificate in that line of work, that also counts. So it's not a hard stop. The lender wants to see 2 years worth of items, but what we try and do is get that, and then study what works and not works, what we can use and not use.
Okay.
The next thing we would need is asset documentation, meaning bank statements. In fact, that's secondary for us, because the first thing is, if we don't have the income, we're not going to be able to find the assets. Meaning, a lot of people get a gift, a lot of people get some down payment assistance. If we don't have the income piece and the credit piece, the asset isn't that big of a deal. And we found that finding assets is a lot easier than finding income or credit.
And when you say assets, can you clarify what you mean by that?
Yeah. Any bank statements you might have, checking account, savings account, 401k account.
Okay.
Those are the main three right now: checking, savings, retirement. If you have a CD, that's kind of what we're talking about.
Okay. But then in addition to that, there could be a gift from the parents or another family member, gift funds that can be used towards a down payment.
Correct.
Okay.
And different programs require different documentation on those gifts. I can get into that later if you want, but
okay.
In a nutshell, yes.
Okay. What's the difference between pre-qualification and pre-approval?
Okay, to me, there's a big difference. The pre-qualification comes in when someone does fill out that loan app and they submit it to us, and we look at it and we give you a pre-qual letter. Now, that pre-qual does not have, many times, or many people do it differently, haven't verified that income is what's been put on the loan application, haven't verified if those assets are actually in the bank, haven't verified 2 years worth of work history. And every file has a little bit of something. So what we try and do with all our buyers is get them pre-approved. And what that means is that comes into us, we do all that documentation, and then we actually submit it to our underwriter, so that our underwriter has now looked at that file. And when they give you that approval, then basically we're done. We like to call it like the golden ticket.
Okay.
We have a handwritten or a written approval from our underwriter saying, hey, all we need is an appraisal prelim and we're ready to go. So if you're serious about looking at a house, I believe you want to get pre-approved. And I'm sure you've heard those stories out there where people are pre-approved and then they're in contract, and at the last minute the deal falls apart. Well, they weren't pre-approved, they were pre-qualified.
Okay. Yeah. And we'd like to, of course, we want to avoid that. So how much money do buyers have to put down? Some people say you have to put down 20%. Is that true?
No, not true at all. A lot depends on, it's not a black and white answer, because there's so many variables that go into a bank lending money to people. But one of the most common loans that I actually do right now is a 3.5% FHA loan. That's probably the most common for first-time home buyers. There are, and I don't think you're going to ask me about down payment assistance programs. There are also a lot of those programs available. And a first-time home buyer is allowed to get each of those programs. And it's not, to be honest, those programs are allowed for non-first time home buyers as well. So we like to kind of refer to them as just little down loans instead of first time home buyers. So then there's also conventional loans with as low as 3% down. Each loan is kind of custom tailored to that client.
Okay. So then, and I think I know what the answer is, but maybe not everyone does. The 20%, why are we all obsessed with this 20% number?
20% is kind of the magic number where you don't have to pay PM or MI. MI is mortgage insurance. Okay. If you ask me, mortgage insurance is garbage. And what it is it's as a percentage of the loan that is paid to the lender to ensure that you will not default on that loan.
It applies if you're paying anything less than 20% down.
That's a good standard rule. I mean, there are exceptions to every single thing. You can buy it out, but yes, that would be pretty applicable.
Okay. So what I'm getting at is I think the reason why we all have this magic 20% down number and why people think they have to have 20% down is because kind of in the ether, people know that once they get to 20%, they no longer have to pay the mortgage insurance, which of course it makes their payment bigger.
Yes. And the mortgage insurance there's two different types of mortgage insurance. There's private mortgage insurance, which when you're getting a conventional loan, that is what we would shop for. There's probably 12 different companies that we go to that we shop for on each client's a little different. If you have a high credit score and you're putting 10% down, that mortgage insurance is very small. It's actually not bad at all.
Okay.
Or if you're putting 15% down, so you just can't get to 20 and you're thinking, well, I got to wait. It's minimal. It's probably at about a 0.17% that it's $100 to $200 a month. And that can fall off in 2 years. So it's not a deal breaker.
Okay. Good to know. I didn't know that. And when you say that could fall off, can you tell me the process of how I get out from under?
Yeah. So whoever's servicing your loan at that time, we have to keep it for 2 years minimum. And then you're not going to pay out down your house that quickly. Most instances. I haven't had anybody. Yeah.
Unless it's the COVID unicorn years where you get 25% appreciation in 1 year.
Totally. Well, sorry. The 2 years is the appreciation is what you have to wait. But if you want to pay your loan down to get to that 20% level of what you paid for, you can do that in less than a year. But let's go with the appreciation. You've got some appreciation. You paid the loan down. Then you'd call your servicer, which we would help you with. You call them and say, hey, I've had this loan for 3 years. I put 10% down at the time. It's now worth 10% more than I bought it. I paid 5% of it down. We'll get an appraisal on the property. They'll either order it or we'll order it. We'll send it to them. And then that drops off your conventional loan. That's only on a conventional loan.
Okay.
Do you want me to touch on?
Yeah. For FHA, same thing.
No. So for FHA, that mortgage insurance is tied to that loan for the life of the loan. Okay. Mortgage insurance is on an FHA loan. If you're putting down less than 10%, so it's almost most FHA loans is calculated at 0.85%. So that's a little bit steeper.
Significantly more than the other one you said, 0.17%.
And it's that 0.85% of the current balance. So it will go down each year, but we're talking minuscule. But which is why when we're meeting with people, when we go over the pros and cons of an FHA and a conventional, this is one of the big cons, if you ask my opinion, of an FHA.
Wow, I didn't know that. So this is really important information. So if I have an FHA loan and I'm putting 3.5% down,
which is the common norm,
which is the norm.
Yep.
It's going to take a very, 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 very long time, presumably, unless we're in an odd COVID market, to appreciate enough to get to 20% loan to value.
Yep.
And so no matter what, I'm going to be paying private mortgage insurance during that time.
Yep.
For this time.
Yep.
Now, let's say I am in the middle of that and I still want to stay in my house. I don't want to move. I still want to stay in my house. Could I then, as I start to get more appreciation, could I then refinance into a different type of loan? Would you recommend that? What would you recommend?
Depending on what the rates were, but yes. And with an FHA, there is 2 options. You can get what's called an FHA streamline refinance. That was big in even without the appreciation, so you can refinance an FHA loan and you don't have to have that 20% equity. If you're just going to drop your rate, if you're buying today and you get your rate at 7%, and in 14 months from now, we've seen no appreciation, but rates are back down to 5.5%.
Okay.
You can do what's called an FHA streamline.
Okay.
And just refinance and it just lowers the first, which is we did a lot of those. Or if you're, like you said, in a crazy market where the appreciation went up quite a bit, you could refinance into a conventional loan. There's no prepayment penalty on any of those FHA loans.
Okay.
Ever.
Okay. Good to know about the FHA streamline. So if I get an FHA loan right now, I put my 3.5% down. I have about a 7% rate or 6.75%, whatever.
Yeah.
But then a year from now, the rate's at, 5.75%, then I can do a streamline refinance for that.
Yes. And what we like to do, different lenders have different rules. We don't have a rule on it, but if you're not saving at least about 1%, we don't recommend refinancing. I mean, every circumstance is different, but as a general rule, if you're at 7%, we're not going to have you spend the money to get to 6.5%.
Okay.
We don't see the value in that.
Okay. Well then, and I know again, we're continuing to be off script, but this is great content. Why am I getting, if I can get a conventional loan at 3% down or an FHA, I know the FHAs tend to have slightly lower rates, but why am I getting an FHA if the mortgage insurance on a conventional?
Okay, perfect question. So, and this is why every client, every homeowner, every potential person is different. It's what kind of their profile meets.
Mm-hmm.
To get that conventional loan on a 3 to 5% down conventional loan, to maximize the rate, you need to have a high credit. You need to have a very high credit score, and you need to have a low debt to income. Okay. Excuse me. Okay. If you have both of those things, you need to be under 50 on your debt to income ratio. You need to be basically under 40 on your front to get a DU approval on that.
What is under 40 on your front mean?
Sorry, their front end ratio, your debt to income ratio of just your housing expenses is called your front end ratio. Your back end ratio adds your housing expenses plus car loans, credit cards, student debt, and those sort of items. FHA allows you, if you have a stronger file, to go a little bit farther along. There's not a hard rule on it. It's whatever desktop whatever the debt DU approval shows.
Okay.
If you have, let's say you have a 675 FICO score, okay, I think that's not far off of the national average. So it's good, but that's not great.
Okay.
Your loan, now we're not talking rates here. I'm just going hypothetical because rates are different and everything. But if your FHA rate under that scenario was 6.75 and your conventional rate because of that credit score is 7.5, then we look at it and go, okay, we want to go with the FHA loan because that's too big of a difference. Okay. And I spoke earlier about that mortgage insurance, the private where we can shop for it. Well, if your score is a 670 rather than a 750, I told you it'd be at like 0.175. It would be closer to 0.89, depending on what our loan to value is. So your payment is actually higher with the conventional loan. Okay. Just depends on the person, on the file itself.
Okay. But still, I mean, the kind of high level takeaway I'm getting here is even if there is an option for me, potentially, not for me, but for me as in the general buyer, maybe to do a conventional, there may be a reason for doing a conventional loan, even if I'm only putting 3 to 5% down. Correct. Versus just the FHA.
Correct.
Okay.
I would say on big picture, I would say though, out of the 100 3 to 5% down loans, I would say certainly less than 10% are getting the conventional. Is the conventional loan a better program for that person? Okay.
So it's really so custom and tailored to that person in their individual debt scenario, their individual income scenario, and their credit score.
Yep.
Okay. Got it. What is a VA loan?
VA loan is, well, it's kind of what it sounds like. It's a veterans assistance loan, and it is for veterans. And that is the only people that it is allowed for. If you want my opinion, when I first got into business, realtors did not want to take VA loans. It was and I don't even really know why. It was kind of a bad word or whatnot. To me, I think they're the best loans on the market, and I'm glad they're the best loans. I think the vets should be receiving the best loans on the market. A beautiful thing about it, I won't get too in detail of it, but it's a 0 down loan and there's no mortgage insurance. And generally the rates are better than a conventional rate. So if any of you vets are out there that do watch, they're going to watch this and listen to it, that's the loan that you're going to want to inquire about with your lender, because to me, that's the best loan on the market. I would say the negative that maybe happened years ago is that it requires to have a termite clearance. You got, section 1, only section 1. That's, if it's a 90-year-old home that's beat up and there's tons of termites, maybe the seller doesn't want to take a VA loan. Other than that, and there's some seller fees. There's some fees that the the vet cannot pay that the seller will pay, but it's minuscule when we're talking about, and $600 to $1 million home.
I echo I echo what you say. I think it's absolutely the best deal in town. I think that these guys and gals should, be able to have a piece of the country that they have defended.
Totally.
And the thing to me, it has in the past, and maybe it depends on the market. If you're in a highly military, populated area, maybe it's less so. But for the VA loans that I've done, or I haven't done, but that I've represented buyers with VA loans, the income is probably more guaranteed than any other person in the private sector, because the numbers are just like, I guess I'm not sure. I'm not exactly explaining myself right, but I just think, like, if you're a seller and you're receiving a VA loan, like, obviously you're getting a pre-approval from their lender. All of those numbers are hard and fast. There is not, there's no fudging of numbers there.
Right.
So you can feel confident
totally.
that, that money is going to come in if they have their pre-approval. So
and when we were selling a lot of those houses that we would buy and sell those, when we get an offer with the VA loan on it, that, besides just the emotional part of it, the number, like you said, the numbers part of it was like, let's go with that one.
Yeah.
Well, wait, they're not putting anything down. Yeah, but they don't need to. And the guidelines are they're the most lenient guidelines as well. You could go in the farthest back end ratio on it that you can on some of the other loans. So big fan of those loans.
Yeah. Okay. Awesome. How long does it take from start to finish to get a loan? From, when I go to your website and I put in my info to get pre-approval till closing day?
This is what I'll tell you. It'll take as long as you want it to be. And what I mean by that is, if you're organized and you send us everything we ask for, we could fund a loan from the day you write the contract to fund it, where you in your house in 10 days. 10 days is our minimum. So it has to be at least 10 days, but that's not an issue at all. It really, and once again, it's the file. If you have a borrower who's got 4 houses, 4 different careers, 4 different jobs, 10 different bank accounts, that's going to be a little more difficult than your straight, cookie cutter loan. But it is a very quick process. It is a very quick process. Our deal is everything's 24 hours. So underwriting, docs, funding, everything's 24 hours.
Okay. So when you say everything, each step of the process, you can expect it to take 24 hours on a business day, but not on, of course, because underwriters don't work on the weekends and whatnot.
Yep.
Okay. Are there any special programs or incentives for first-time homebuyers?
Yeah, that's another funny question that you asked, that because it really depends. Once again, I'm not being elusive on these answers, but it depends on the person. When I have somebody with 20% down with a 750 FICO score and they say, hey, do you have any first-time homebuyer programs that are good for me? And I say, yeah, but we have first-time homebuyer programs, but you're better than what you can get on the open market is better than any government subsidy program. Does that make sense what I'm saying there?
Yeah.
So there are programs, but nothing quote unquote is free, and so a big loan, I'm not sure if you're going to ask me about that, in California, as big as the CalHFA loan. And that is there's a lot, we won't get into detail of it, but that is a first-time homebuyer program to help people with no money down. When people call us, that's the first thing they ask about. Well, then we kind of look at the numbers and see what the payments and the rates are going to be compared to what if they just had the 3% down themselves to get either a regular FHA or a regular conventional loan. So we just look at that per client, but some people it does fill a need, and it is and different right now. This is off subject too, Nancy. On different subdivisions now, there's a lot of homes that the builders, the municipalities are making the builders have what's called BMR, below market rate homes. Sure. And so there are a lot of those out there that people are working on getting approved for. But once again, there's restrictions on those, and a lot of restrictions. So there are programs, but we just have to see what is tailored to each person's needs.
Mm-hmm. So I think you're right. That gets what we're talking about in the builder programs anyway, and even with the CalHFA dream. Yeah, CalHFA is a shared appreciation situation, and we don't need to know what that is now, but we do need to get into it in the future in a future ROBcast, because it's a complex topic. It is a restriction on it is a restriction, and for some people it may not resonate to be in that situation. If for those people who know that, or they intend to live there for the next 20 years and they feel really, really confident about that, then it might make sense. But we can get into that later. Okay. So I think that's the general point is there's a cost. There's a cost. There are programs, but those programs may come with additional restriction or or other things that might be a drawback.
Yeah, like for example, maybe on the CalHFA, and I don't want to, like I said, I don't want to confuse anyone, where you get the money for the 3% or 3.5% down. Well, then your rate's a little bit higher on your first, and then you can get another 1% or 2% to help cover closing costs. Well, the rate goes up a little bit more. So what I try and tell people, and you're paying for it somewhere. You're paying for it somewhere, but once again, if it fits that person's needs, if, hey, we're a high income earning people, we had some debt that we've been paying off, we just can save up to get this 3.5% or 5% down, but we really want this house and our ratios work good, then that's the program for you, know? Yeah. And so we discuss that with each person, but it's not as broad as saying, I'm a first time home buyer, I want one of these things, because a lot of times there's something better for them that's on the market. Okay. And the key is the knowledge for them, is you need to speak with someone who knows what they're talking about and can give them those options and say, hey, here's why you want this and don't want this, but based on your case. Well,
the decision rests with them, but they need to have information. Yep. And if you're just kind of like, searching on Google or whatever, and you're not dealing with an expert who really has your best interest in mind, then you're kind of, you're floundering a bit.
Right.
So we already talked about private mortgage insurance. You had mentioned MI and PMI. I wasn't aware that there's a difference. So
I just call MI mortgage insurance because with FHA, it's non-negotiable. You can't shop it around. That's what it is. Private mortgage insurance is private, different banks, MGIC, Radiant, a bunch of different private mortgage insurance companies that have it. It's probably just me who says it like that. Okay.
And so the conventional loan mortgage insurance can be shopped around.
Yes.
The FHA loan is the set. Okay.
Correct.
Got it. How much are closing costs, or what are closing costs? And it's kind of a tricky question in light of changes in the real estate market right now, but we're just going to pretend that, since all of things are up in the air in terms of buyer agent fees and that kind of stuff, I'm just going to ask you as if this were 6 months ago, how much are closing costs and what are closing costs?
Well, I'll discuss it on the purchase side, because that's the side I deal with. We're never on the seller side, so I'm not even sure. That's kind of a different animal.
Sure.
Closing costs, you're going to have two different types, or two kinds. One is called your prepaid items, and one is your fees. Okay, and really the third is the points you're going to pay. Okay. In this market, since things changed, to get a rate that's even reasonable right now, you're going to want to buy some points, whether it's between 1 and 3 or 4. We strongly suggest that at this point, because the ratio between not paying points and the rate to paying a point or two is too great not to pay them. Okay.
Just because we haven't talked about, I'm sorry to interrupt, but
Yeah.
just because we haven't talked about points at all, let's
Yeah.
start with talking about points, explaining what points are, and then going back to the 3 things which
Okay.
were really helpful: the prepaids, the fees, and then the points. So I'm
Yep.
going to reframe my question. What are points and why do I want them?
Yeah. Okay. Perfect. And once again, that was another bad word. Like when you first got into lending, like I wanted, we'd have people, march into our office. I want the best rate and I'm not paying any points. Okay. I'm not paying any points. I'm not paying any points. Okay, great. Well, when the market crashed in 2008, they kind of changed the way that lending and the way we could lend money out. So as a lender, and this goes for any lender, when we show you the pricing and how much that each rate costs, we don't care what you pick. We don't care if you pay 1 point, 10 points, no points. We get paid the same. It doesn't matter to us. So what we do is we show you what the cost is to get that rate. When someone asks me what are today's rates, and this is the truth, you could get a rate right now at 5%. That's on the market. You're going to pay 7 points for that. And what a point is a percent of your loan amount. So if you have a $500,000 loan and you're paying 7 points, that's $35,000 that you paid to buy your rate down. Okay.
Because 1 point is $5,000 and 5 times 7 is 35.
On that scenario, yes.
Yes, in that scenario.
Yep. And so the point is whatever the loan amount is.
1% of the loan amount.
1% of the loan amount. What another general, once again, these are general rules of thumb, depending on what the market is it takes you about 4 years, 48 months to make up a point. And what I mean by that is if you bought your house and you're going to pay a point, your payment's going to be lower because your rate's going to be lower, and your rate's going to be lower for the rest of time. But if you keep that loan for only 2 years, you didn't make back up those points you paid. If you keep that loan year 4 through 30, you made up all that money. Now, that's one reason why people pay points. The other reason why people pay points, especially right now in this market, is to get the payment lower. I mean, a rate at 8% compared to a rate at 6% is astronomical. And so if the seller will pay, or in our terms, a lot of times the builder, I'm sure you've seen at every subdivision you go to, the builder, they didn't lower their prices. They paid for closing costs. They bought down people's rate. And so that's where, maybe they don't plan on staying in that house forever, but they were able to get that lower payment for the next 3 years. And that's why they had to do it.
Okay.
So it's not a bad word. It's what you wanted. I said on myself, me and my family were in our forever home and I paid like 4 points. That's before people were really paying them, because I thought I was buying my rate down from like 6 to 5. And a year and a half later, rates were lower and I refinanced again. So I lost a lot of that money, but I did it again. And then my rate was at 2 3/4 for 12 years because I paid all that money. So I won on that deal.
Mm-hmm.
It really depends on each person's situation.
Mm-hmm. Mm-hmm. And that's really helpful. Okay, so now we know that they're in the closing costs. The question are what are closing costs? We know that there are 3 types of closing costs: prepaid, which you'll get into what that is, fees, and then points. We already went over points. So prepaid closing costs. What are those?
Let's go with the fees first, if that's okay.
Sure.
What those are your title and escrow fees, title insurance, and you as the realtor negotiates how that works between who's going to be paying those. So those are the title company's fees. They're generally same thing. I actually don't know much about them because that's their deal, but I think they're generally, whether you go to Fidelity, Chicago, First American,
pretty comparable.
I think they're pretty comparable.
Yeah.
So there's those. They'll have their notary fee in there. They have their fee set up a little bit different on each transaction as itself. Then you're going to have on our end, most lenders have a processing fee and an underwriting fee. maybe one other one. We only have processing and underwriting. And those are generally, I think, what are $800 a piece. So $1,600 and bank fees, lender fees. You're going to have an appraisal. The lender, I've answered this a couple times this week. The lender, you as the buyer and the lender are the ones who require the appraisal. The lender wants you to have the appraisal. The seller doesn't care. Okay. The seller does not care. The seller never even sees the appraisal. You were willing to pay $500,000 for it. It doesn't matter what it appraised for. And, we could go over a different one of, that sort of deal on when you're buying a house, if it doesn't appraise or whatnot. That's a different topic. So you will have the appraisal that you're required to pay for. So you have your bank fees, you have your appraisal, you have your title fees, then you have your recording with the county when you go and literally record the deed and the tax they make you pay on that. So those are your main closing cost fees. So
Okay.
that covered that for you?
Yeah, and in the future, they may include buyer's agency fees, but we can get into that topic later because we're just talking about right now, today in May 2024.
Yep.
Okay. And then what are prepaids?
Okay, prepaids. If you do not put at least 10% down, you have to get what's called have an impound account or an escrow account. You might have heard it said both things. Okay, this is kind of confusing. So when you buy a house, they want you to come up with, depending on the month of the year you close, but let's just use 6 months in advance. And they want that into an escrow account.
Make it happen.
Okay.
Sorry, my Alexa was talking to me. She was telling me to have some tea, but can you say that again?
Make it happen. So make it happen. So you would have 6 months prepaid items, 6 months of taxes.
Okay.
So of property taxes, and that goes into an account, and that's your money. It's in an escrow account. They're also going to require you to put in 2 extra months worth of insurance. So if your insurance is $1,200 a year, there's another $200 that went into this account. You also, when you purchase a home, have to pay for a homeowner's insurance for an entire year. That is also a prepaid item. Prepaid items means it's your money. It's not a fee. It's nobody's fee. And whether you go to PMR or Bank of America or Wells Fargo, they're all, we have nothing to do with the prepaids. But you have to have, if you don't have at least 10% down, you have to have these in your escrow account. Okay. Then when your monthly payment is due each month, and then the last number is your prepaid interest. Okay. And what do I mean by that? Especially for first-time home buyers. When you buy a house, it's the exact opposite of rent. When you're renting a house and June 1st comes, you write a check on June 1st, and that covered all of June. When you own a house, you pay after you live in it. So what do I mean by that is today's May 6th, and you and I have a transaction together that's closing May 15th. Okay. We're going to collect interest. This is kind of confusing, from May 15th to May 30th. So 15 days of interest. Now, depending on your loan amount, that could be close to $2,000, $3,000, $4,000. Okay. And that goes into your impound account, escrow account, or prepaids. But your first payment is not due until July 1st. Okay. Now, a lot of times you hear in the lending industry and real estate, you hear everyone wanting to close at the end of the month. We got to close at the end of the month. We got to close at the end of the month. The reason that is you don't have those 15 days of interest. You only have 1 day of interest. So your buyer has to bring in that much less. So everyone says, well, I want to close at the end of the month. Well, but then you have a payment in 30 days instead of 45 days. So it's all apples to apples, and you weren't living in the house. So you look at it that way.
Yeah.
And so when you make that payment on July 1st, you paid from June 1st to June 30th.
And they call that paying in arrears.
Yep.
Okay.
And the other part, the money coming in, prepaid interest. That's your prepaid interest. That's the only time you're paying for the money before you've actually borrowed it. Okay.
So I've heard different percentages thrown around, and I know that it's completely different because it matters how many points you put down and how many, there's so many variables. And if you're not comfortable with it, just say I'm not comfortable with it. But is there a percentage that you could say that buyers/borrowers should expect to pay 2% in closing costs or 3% in closing costs? Is there some sort of percentage that you can?
Yeah. Yeah. We used to say 2%, but with wanting people to spend more, I mean, I feel bad saying this, but spend more money on getting their points lower. We tell people you should figure about 3%.
3%. Okay. And just to
Of
clarify,
the sales price.
Of the sales price, not of the loan amount.
Yep.
And to clarify on that, when you say wanting people to spend more money, you're not wanting them because you guys at all benefit from that, but you want to see them have a more comfortable payment. And you'd rather see them pay in the front end for points to have a more comfortable payment.
Correct. So if you, like I said, if you pay 5 points, that's not going to your lender. That's going to the bank to buy down the rate. That stopped in 2008-9.
Okay, good. So we talked for a good amount of time, and I do have more questions, but I think we're going to add those to first time home buyers part 2.
Okay.
So I really appreciate your time today. And
no problem.
This has been super fun. I actually learned a ton, and I'm embarrassed to say I've been in the industry, you know, been an investor for a long time, but I've been a realtor for 7-8 years, and I learned a lot today. So it's always good to sit down and talk with you guys.
Well, that's my favorite part is teaching people on it. I think it's one of the main things. It's the biggest expense you're ever going to make. As you see, that's why I kind of get a little too chatty, because it's the biggest thing you're ever going to buy in your life. And if you know about it, it's just going to benefit you. And I believe that is how you can build wealth, is through real estate. So
absolutely. Generational wealth.
Yep.
Yeah. That's what we're here for. Okay. Awesome. Until our next ROBcast, I'm super excited, and I'll see you next time.
Okay. Thank you.
Okay. Thanks,
Bye.
Rob. Bye.